Thank you for joining us today. My name is Laith Khalaf, Head of Investment Analysis at AJ Bell. And today I'm going to be talking to you about investing in the retirement runway. So that is the tricky age as you're approaching retirement. Tricky from an investment strategy point of view, because when you're building up your pension, what you're looking for is pretty straightforward. It's growth. Achieving that growth might not be quite as straightforward, but you know exactly what you're looking for. And equally, when you hit retirement, what you're looking for, generally speaking, is income. Again, so a pretty well-defined thing that you're looking for. And it's the bit in between that we're going to be looking at today, which can be a bit, as I say, tricky from an investment strategy point of view. So let's kick off by looking at what you want to avoid. So this is the value of £100,000 invested in a global equity fund during the financial crisis. So as you can see here, if you had £100,000 invested in such a fund in your pension pot, then over the course of less than 2 years, you've essentially seen your pension pot decline by around 30%. That's going to have pretty big implications for how much income you get in retirement, potentially whether you can retire at all, as you foresaw. You really don't want to end up in a situation where you're seeing such a big fall in your pension pot just as you're about to retire. So it's important that you're not taking too much risk as you're approaching retirement. Now, on the flip side of that, you do want to take risk when you're building up your pension pot. So this is basically a slide just showing you the 20-year returns from various fund sectors. Starting from lowest risk on the left over to highest risk on the right. And what we mean here by risk is really how much you're invested in equities. So over on the left, you've got a maximum of 35% invested in equities. Over on the right, 100% invested in equities. And as you can see, obviously, as you probably know, the greater the risk you take, then over the longer term, the more return you should expect. Now, I would probably say that most default pension funds within group workplace pensions, so those are the funds that your company chooses for you if you don't choose one yourself, most of those probably sit in between the second and third category here. So for some people that might be exactly where they should be, but I think for a lot of people, actually, particularly at younger ages, actually there's an argument that they should be taking on more risk to try and harvest those longer term returns. But as well as returns, you can see the red bars at the bottom there, which are showing you what your maximum loss from peak to trough would be over those periods as well. And you can see again, as you're taking more equity risk, you're also building up the potential for seeing very big falls because equities are volatile. And again, what we're trying to do is obviously kind of harvest the growth during the years in which you're building up the pension, but then avoid those big drawdowns just as you're about to retire. So I think it's instructive to basically look at the traditional way of dealing with de-risking as you're approaching retirement, just to kind of look at some of the flaws involved in this approach, but also seeing what we can salvage from it as well. So the traditional approach is called lifestyling. What happens in a lifestyling program is typically around 5 years before your retirement, you start being moved out your growth or managed fund within a company pension, and then gradually you are shifted into cash and bonds or an annuity hedging fund. So your cash is built up to provide you with your 25% tax-free cash lump sum that you can take from your pension at retirement. And the bonds are built up. The idea behind that is that you gradually build up bonds because bond prices move in the opposite direction to annuity rates, which is why the funds that you're invested in are often referred to as annuity hedging funds. So the idea is that kind of the more you approach retirement, the more you've got invested in bonds, so that if annuity rates are going up, your pot is going down, but equally if annuity rates are going down, your pot is going up. And so the idea is that what you're doing is you're leveling off the two and reducing your income volatility, your retirement income volatility as you approach retirement. So that's your kind of traditional, conventional way of de-risking as you approach retirement. Fortunately, there are a few problems with that. So the first is that you are still exposed to just one asset class, bonds. In this case, which are less volatile than equities, but still bad things can happen. And in recent history, they have happened. this is the kind of performance of a typical annuity hedging fund over the course of 2022, really, when interest rates rose. It was an exceptional period of interest rate rises, but still, this kind of shows you your worst case scenario of what can happen. And you can see here again, you've got a 30% or so fall in the value of your pension pot fund just as you're about to retire. So not exactly a great result. Now, you might say that over this period, annuity rates rose to compensate you, and that is true. Annuity rates rose by the same amount. So actually, yes, you might say, well, actually, I've lost 30% in terms of my fund value, but annuity rates have gone up 30%. So, I'm actually kind of exactly where I started, which I'm relatively happy with. I think there are two kind of problems with kind of just relying on that. The first problem is that there's a psychological issue that if annuity rates are rising, you probably expect more income from your pension rather than the same amount. I don't think too many people are going to be thanking their fund provider for, presiding over a 30% fall in their pension fund just as they're about to retire. Particularly because a lot of these lifestyling programs were set up as default pensions. So people haven't actually made an active choice to lifestyle. It's been chosen for them. So they probably don't even know that it's going on in the background. And the second reason is probably more substantial, is that so many people are just not buying an annuity anymore. So you're looking at around 10% of people now buying an annuity ever since the pension freedoms were introduced almost 10 years ago. Now, that compares to a very different situation before that, when 90% of people were buying an annuity with their pension pot, and when all of this kind of lifestyling strategy was devised. And I think it's worth just being aware that if you've got older pensions, particularly provided by insurance companies, kind of things like group personal pensions, individual personal pensions, individual stakeholders, then they may have a lifestyling program that's waiting to kick in when you hit 10 or 5 years to retirement. It might just be ticking down that kind of clock until you hit that point, and then it kicks in automatically. So if you do have any of those older pensions, worth just making sure if this kind of strategy is on there in the background, because as I say, for a lot of people, it's not appropriate anymore. So if you decide it is appropriate, great, but just worth being aware whether you've got one of those programs on in the background. So I think what this also throws into focus is that if you're thinking about how you're going to invest as you approach retirement, is actually quite important actually to think about how you're going to draw your retirement income. Because if you can see here, this is all based around someone buying an annuity. What if they're not buying an annuity? You have to kind of address that issue. There are broadly speaking three ways that you can draw your pension income. The first is an annuity. So for the uninitiated, that is an insurance product. You essentially take your pension pot or whatever, £100,000. You take that to an insurance company and you say, can you please give me a fixed income for life? That fixed income is then guaranteed by the insurance company. Now, the other option is drawdowns. That's where you keep your pension invested and you draw an income from it over the course of your life. And the third option is cash. You can simply take all your pension out as cash. Might not be the most prudent thing to do, but it is possible. And of course, you can actually mix and match the three approaches. And actually, whether you're doing annuity or drawdown, actually, you're probably going to use a bit of cash because most people will end up taking their 25% tax-free cash. That's what it's there for. It's important not to look a gift horse in the mouth, particularly when it comes from HMRC. So building up a cash pot is probably going to be part of the solution for everybody. So there's plenty of things to think about in terms of when you're considering which of these options to take. Probably a big question is when you should be thinking about this, and I don't think that there is a definitive answer to that question, but it feels kind of sensible to kind of 10 years before retirement. I think it's a good time to start at least thinking about this kind of question, because that gives you plenty of time to adjust your strategy. Of course, things will change over that time, but you also have time to kind of be flexible and make changes if needed. In terms of the decision about whether to kind of buy an annuity, drawdown, or cash, then a lot of it will come down to your risk tolerance. Annuities are low risk because they are guaranteed by an insurance company. The return you get is very much determined by bond yields. So, 5 years ago, they weren't very good. Now they're much more reasonable. So you might want to take that into account as well. And also kind of, how hands-on or how hands-off you want to be with your retirement portfolio. An annuity, you just hand the money over, you get a fixed income for life. With a drawdown where you're investing, you need to be more hands-on. You need to kind of keep an eye on what's going on within your portfolio and make investment decisions. Now, the benefit of that approach is that it is more flexible. You can vary your retirement income, depending on your retirement, expenditure needs. Sometimes some years they may be higher than others. You can also kind of vary your income to manage your tax liability to keep your tax as low as possible. So they are more flexible than annuities. You have more control, and I think that's a big reason why actually since the pension freedoms drawdown plans become much more popular. And when you're also thinking about this kind of drawdown annuity cash jigsaw, think also about your retirement income in holistic terms. So this isn't just about one private pension. You probably might have several private pensions, state pensions, final salary pensions. If you have a lot of income from property or ISAs, then that might mean that you can take a bit more risk with your private pension. If your private pension is all you've got, then actually you might be thinking, I need to kind of a secure income, and an annuity might be for me. So, those are kind of some of the considerations you might want to take into account when choosing how you're going to take your retirement income. Once you've got an idea of how you might take your retirement income, as I say, one of the things that I think we can salvage from the idea of lifestyling is this idea of gradually switching out of higher risk assets into more appropriate assets for whatever retirement profile you've decided to take, whether that's drawdown annuity or cash. And this is kind of an example from a company pension scheme. It's just one example, probably overcomplicated for our purposes, but it gives you an idea of what we're talking about. Gradually shifting across into, generally speaking, lower risk assets. And rather than doing that in one fell swoop where you've got the risk of kind of market movements moving against you, you're doing it gradually. So you're kind of smoothing that journey. And then if you're kind of thinking about what assets you can use, depending on which of the various retirement options that you've chosen, well, if you're looking to take cash from your pension, if you're just going to take it all out as cash, if you're just looking to take it all out as cash, then probably what you want the day before you retire is just all of your pension in cash. So you would gradually build up the cash that you're holding in your pension, probably through money market funds, which are cash-like. If you're going to take an annuity, then we've seen the kind of conventional approach to that, which is to build up cash 25%, and also bonds as an annuity hedging mechanism. If you can buy an annuity, then that still makes a fair amount of sense, I think. And then the third option, drawdown, you have a wide range of choices in terms of what you might be invested in. So I just want to kind of focus in on the drawdown aspect a bit, because I suspect that that's probably the bit that kind of needs a bit of attention, and that many people listening to this webinar will probably be interested in. And just think about these various sort of options that you have and what they give in terms of the features to your portfolio. So cash can be used to build up your tax-free cash allowance. So we've talked about that, your 25%. Can also reduce portfolio volatility. If you've got a mixed portfolio of shares, bonds and cash, just kind of, diversifying your assets and adding a bit of balance to the rest of your portfolio. You've also got bonds, which also kind of reduce portfolio volatility when held alongside equities and cash, and can also generate an income in retirement. The same goes for cash, can help you generate an income in retirement. And you probably couldn't have said that about bonds and cash 5 years ago, because the yields were so low, interest rates were so low. But now, happily, you can actually diversify your portfolio in retirement and also generate an income from those assets as well. Multi-asset funds, worth mentioning as well. So these are funds which invest across a range of assets. So shares, bonds, cash, property, absolute return funds. There's lots of different options. And these are kind of helpful, I think, for people who don't want to run kind of a whole portfolio themselves. It's just kind of a one-stop shop. It's run by a professional manager, and you can use that to kind of generate an income. And also those multi-asset funds are available across a range of different risk profiles. And what that means is that you can just pick one that's appropriate to your own risk appetite. And then finally, the equity portion of your portfolio, if you're remaining invested for the long term in retirement, which of course can be, can be decades long, then you probably do want to retain some measure of equity exposure within your drawdown plan. So a large proportion of that is probably going to be income to generate the income that you want in retirement. If you don't need income in a particular year, you can always reinvest the dividends that you get from your income portfolio. I think it is probably important to consider having some growth assets in there as well, some growth funds or trusts or shares. And the reason I say that is to have a balanced portfolio, balanced equity portfolio. If you're just going for income, you can find yourself, kind of with a very heavy kind of sector bias to things like financials, oil and gas, mining companies, potentially things like supermarkets tend to be quite cyclical, economically sensitive areas of the market. And that can lead to kind of greater volatility. Whereas if you have a blend of income and growth, you've got more drivers of your return, so probably again a smoother journey, and you can always generate an artificial income from growth assets if you want, by simply taking profits and using the kind of cash to be withdrawn from your pension plan. So those are the various instruments that you can use with a drawdown plan. And then just kind of putting that all together, this is an example of what that might look like. So you start off with 100% invested in your growth fund as you're kind of really building up your pension, and then you move across. You kind of think, what am I, how am I going to draw my retirement income, or what is the most likely scenario for me in my retirement income? If that's a drawdown, then you might say something along the lines where this is how I want my portfolio to look at the point of retirement. And these percentages, you might choose different percentages. You might choose not to include some of these assets, but this is just kind of an example of how you might end up. And that then gives you kind of something to aim for that you can gradually shift across to as you approach retirement. Big question about how long you should take to do this. I think probably you should start this process probably 5 years, at least 5 years before retirement. Because again, you don't want to leave it to the last minute. You don't want to kind of move all your assets across in one fell swoop. And as I say, then kind of, you leave yourself open to the risk of, a big market fall just as you're about to do that. I'd say at least 5 years, maybe out to 10 years, because of course you don't want to go too early either, because you do want to maximize the growth that you're getting from your pension while you're building it up. I think it's also important to kind of take stock of market conditions when you're thinking about this as well. For instance, if markets are riding high, you might want to pull the trigger early on starting this process. By the same token, if you've just seen, a 25% fall in the value of kind of your pension fund because markets are falling, we saw that very recently during the pandemic, of course, just a matter of weeks, really, then you might say, well, I'm going to hang off, starting to switch out of equities until there's a bit of a market recovery. And giving yourself a longer time frame also gives you the kind of flexibility that you can take that longer term view rather than stuffing all the decisions into that last year before retirement when you can really get boxed in. So just to summarize everything we've covered there, so I think it's a good idea to take stock of your pension 10 years out. We've talked about it in terms of how that helps your investment strategy as you approach retirement. But I think it's also a good idea just to make sure that you're on track to meet your retirement goals. If you open your pension box 5 days before you retire, or you're planning to retire, and you find out there's not enough beans in there, then you're not really going to have a great deal of time to do anything about it. So a good idea to kind of take stock of your pension 10 years out. And as you're doing that, kind of consider how you're going to draw your retirement income. While kind of taking a holistic view of all of your sources of retirement income. And then from that, you can kind of build backwards and look at what your investment strategy should be. Lots of different options for you in terms of the funds that you can use to then fill in that strategy. And I think it is worth mentioning that, of course, it's entirely possible to do this, navigate this all by yourself. Plenty of resources available to you online. nowadays. But if you don't want to do that, then you might want to consider taking professional financial advice. I think kind of the point at which people retire, or leading up to the point at which that people retire, is actually a common time when people do take financial advice, simply because there's quite a lot to think about. And also people tend to have, their assets are at their kind of peak level. And so, there are costs associated with taking financial advice. And so those tend to be a smaller proportion of your pot when you're kind of 55 and you to 60, you built up a big pension, then compared to, say, you're 25 and you've got £2,000 in the pension fund. Doesn't make a huge amount of sense paying £500 plus to take financial advice. So just worth bearing that in mind as well. That's all for today. Just a few kind of important investment notes for you to read through. Hope that's been of some use to you, and thank you for listening.